right, welcome everybody. Um, Welcome Jeff Levine. My name's Roger Pine.
What's up,
We
Roger?
are, yeah, we're a minute after the start, so I was going to do that awkward waiting around for everyone to arrive, but we're here. So let's start, Jeff, shall we? I have
Yeah,
a
I see the
few.
numbers rising. We are digitally filing into the room as we speak.
Yes, yeah, we had actually over 4,000 people RSVP for this, so I'm pretty impressed. Obviously, this is top of mind for people. A couple thank yous first. One, actually, thank you to all our customers. Like a lot of people wrote in and they're like, "When's the webinar with Jeff? We don't see it in the calendar." And our answer was we didn't have one planned. But so we're here by popular demand. So thank you to everyone who wrote in and said, "I want to hear a summary of the new stuff." So that's our goal today. We're going to go through the new tax law changes. We're going to show you in the software how to model some of them and then some of the implications in terms of planning thoughts on that. I'd like to thank our team. One of the things, a goal that we set was to have everything built the day that the law got signed. And Jeff, you'll recall that there were changes to the law down to like the last day before
Hmm.
signing. And so that was a lot of last minute and late night work on our side to make sure we had that all ready. And Jeff, I know you were up late also because we were conversing with each other at midnight the night before it's signed. So anyway, thank you to the whole team who, knew a lot of people were counting us to get this done. And so I appreciate all their efforts and appreciate your efforts, Jeff. Shall we dive in?
Let's do it.
All right. So I'm hoping people can see my screen. I already messed up one thing earlier before the event even started. So I'm hoping people see my screen. Should be a slide up on screen. Um, Jeff, maybe as a prelude before we dive in, what would you say? So we're 2 weeks in after the bill got signed, right?
Yep. Hmm.
And what would you say is the level of certainty around what the bill actually means in terms of and we're going to talk about some of the areas where we're going to say we interpreted it to be this. So where would you say the industry is in general, and then your own confidence around like the bill says this, and therefore we understand that it definitely means this?
Yeah. Well, I think we're getting there, right? Each day
Okay.
is another day where some things get clarified. The IRS actually even put out a little release this earlier this week on a couple of deductions that made a few things abundantly clear to folks that were being questioned before. So that's the good news, is that we're getting there. Now, I think, like many things, we are going to need to have guidance here down the road to help clarify a few things here or there. And I would be, when it's election season, there's that like October surprise. I think we're going to get like the 2026 surprise. If you think back to the Secure Act, right? That original Secure Act, nobody really thought the 10-year rule was going to be interpreted the way they finally interpreted it. But that was I'm sure, I don't know what it's going to be, but I'm sure there's something that we're looking at going, this is how it works right now. And the IRS is going to come back. We're going to go, wow, really? So I feel pretty good about where we are today. But I'm also very realistic of thinking like we're still in the early days. There's still a lot to be unpacked. A great question is like there are these new Trump accounts. There's questions about whether or not they're going to be convertible to a Roth IRA down the road. I've heard some people say definitely yes. I've heard some people say definitely no. And I'll tell you, for me, I have no idea. I'm not really sure yet which way. So there are definitely some ambiguous things, but the big things that we probably need to know to take action or not to take action today, I think those are pretty clear at this point. So that's the good
Sounds
news for
good.
everybody on this call.
Sounds good. All right. And just a couple
Let's do
housekeeping
it.
things. The Q&A box will be open. I have no idea if we're going to be able to get to it, honestly. I would love to, but there's a lot to cover in the time we have. So my colleagues are going to do their best to try to answer questions. Please don't take it personally if we can't get to your question. There's just so much to cover. And then the second thing is, yes, I believe this is being recorded. And so we always get like 1,000 questions. Is this being recorded? Yes, I think it's being recorded. In fact, I see it is being recorded. All right, Jeff, the first thing, which I thought would be an easy one, is the
Nothing is
brackets.
easy.
Not easy. The very first line of this section of the bill was about the tax brackets. They didn't sunset. We got to keep them high, but then they added in this special language that we interpreted it to mean that we're going to double up the inflation adjustment in 2026. So Jeff, I'm going to show on screen what's going
Mhm.
on there, but if you want to try to introduce how we are interpreting that to mean, and I'll get it up here on screen, how we
Yeah.
built it into
So,
the
so
software.
Yes. So basically what's going on is all the brackets sort of continue to exist as they are today. The 10, the 12, the 22, the 24, the 32, the 35, and the 37, those remain the brackets. And everything gets its normal inflation adjustment for next year, but the 10 and the 12 is how we're reading it, are going to get an extra inflation bump. So instead of having, let's call it 7 years worth of inflation or 8 years worth of inflation, whatever it is back to 2017, we're going to get one extra year's worth of inflation adjustments for the 10 and the 12% bracket. So effectively what that does is it allows more income to be captured at that 10% rate, not just for those with more modest income, but also for those at the higher end too. Remember, everybody gets their 10% bracket. So a wider 10% bracket, a wider 12% bracket, and then the net effect, because the 22% bracket effectively will end at the same place it otherwise would have, because the 12 is pushing up and the 22 is staying the same where it ends, the 22 actually ends up starting later and the 22% bracket shrinks. But net, that's still a good thing for clients, right? It means effectively we're shifting some income that would have been at 22 into the 12% bracket and some income that would have been at 12 into the 10. So net, a good thing for clients.
Yep. And just to show you how you could see this on your own within Holistiplan yourself, here we still have the ability to run the calculations based on not only TCJA, but TCJA with no sunset. And so I've got those side by side here, and you can see it. Maybe you're gonna have to just remember because I can't put them side by side necessarily, but this is the new law. Yes, the new law. We had the 10% bracket ending, and I'm using a 3% inflation assumption. Ends at 25,300. Old law ends at 24,550, right? But you'll notice like, oh, that's how much is in the, but 24,550. But then the 22% bracket, you'll notice in both cases, 212,900 and 212,900. So like Jeff was saying, everything above the 12% bracket, the 22 shrunk, and then everything above 22 is totally unchanged. Jeff, actually, we ran the numbers this morning, and it's not really that impactful. I mean,
Yeah.
here, I'll show you. So
Sounds
here's
good
side
though.
by side.
Mhm.
I mean, I'll take the money any day, but look, these two scenarios where I have income that takes me into the 22% bracket, the
Mhm.
total tax difference between with and without this extra little inflation thing is $315. So
Yep.
that's real money. I'll take it. I would pick it up
Yeah,
if I saw on
and
the
you know
ground,
what?
but
I
it's not
think
a big
it's
change.
real money to the folks that are going to be in those smaller brackets, right? And those lower brackets, I should
Yep.
say. That $300 be a meaningful percentage of their income, but for your clients who are making, $200,000, $300,000 a year, they're not really going to feel that extra bonus there. But it is
Yep.
going to be on their return. They will pay less tax because of it.
Sure. And then I'm going to try to do a takeaway on each of these things that we cover. And one thing that was interesting to me is the 12% bracket very likely
Mhm.
will be into six figures in 2026 because of this thing. So it's already in the 90,000s, but it'll be into
Mhm.
six figures for a joint filer. So that's actually kind of surprising to me. So for those
It
of you who
is,
are
and
filling
couple
12%
that with
brackets with
the
Roth conversions,
Sorry, I didn't mean to step on you there, Roger, but couple that with the larger standard deduction, which I think we're going to cover next, and you start to realize that, you can have for a married couple filing a joint return going into next year, $130,000 plus of income. If you are married a couple and are both retired and 60, well, don't have to be retired, but if you're 65 or older, which we'll talk about later, that's another 12. Like you might be able to get up to $145,000 ish of
yeah,
income at 0% long-term capital gains rates. Like there are some like that we're starting to get to some very, very meaningful income levels where you can capture 0% long-term capital gains rates. And all of that should even impact the decision of like, what sort of account are you going to invest in? Are you like, as you get closer to retirement, is it even the right thing to continue to put money into a retirement account? Or should you start to like disregard the retirement account because you don't have as long of a runway until you're going to use those dollars to benefit from the tax deferral? So there are lots of amazing planning conversations that arise out of all of these changes. But I see you've got the standard deduction up here. So let's talk
yes,
about that, Roger, and
good segue.
specifically the fact that
Didn't
it starts this year.
correct. Yeah, it didn't sunset down next year. It starts this year, and then they tacked a little bit on to the standard deduction. Um, I can show that in the system, but I mean, again, side by side, if you want to pull that up in our system, you can. Both tax regimes, you can put them in our system. But yes, a higher standard deduction on the right-hand side there. What does it mean? It means a higher hurdle rate for itemizing, right? I mean, that's always been the case. When the standard deduction almost doubled or did double with TCJA, it a lot of people who were itemizing suddenly weren't. And those who intended to or had before, we had to come up with strategies to bring itemized deductions into alternating years with things like DAFs. So any other
Yeah.
comments on standard deduction? I mean, it
Yeah,
is
I
what it
think
is.
that's really it, right? Is like the majority of people will continue to take the standard deduction, the overwhelming majority. Now, it's interesting when we couple that with potentially the SALT changes that we're going to talk about later. What does that do for some folks? But I think the big news there is, again, still a large amount of income that is effectively tax-free, right? That's what the standard deduction is. It's the amount of income you can earn income tax-free. That stays relatively high. And again, even a little bit of a boost this year. So if you do some really precise planning with clients and you've done some early year projections, you may just want to pop into the Holistiplan program and update those projections based on the changes that are made to the law this year, which are not limited to the standard deduction, but
Yep.
certainly included in that.
Yep. All right. Well, let's dive into itemized deductions. And you mentioned SALT, which for some reason I put like way down the list. So we're going to have to get through some other stuff before we get to SALT, which is the one people care about.
You
But
know, you were
charity,
just saving the best for last. You wanted to
maybe,
keep everybody on edge. It was
maybe,
good. It was good thinking on your part.
maybe so. So charity, there's three things that I thought were worthy of looking at in charity. I'm going to show all three in the software in a second. But first of all, um, we had this, what was supposed to be a temporary 60% AGI cap on how much you could get a deduction for on donations to charity. Something that honestly, in my time as an advisor, I think I saw once with a client who was like donating a building. Like you don't see it often. And Jeff, I know you have opinions on why you may not want to give that to take that much deduction once you get into pushing yourself into lower brackets with charity. That's
Yep.
another story. What's new and what came on pretty late only in the Senate bill was this idea of an AGI floor on taking a charity deduction. We're used to AGI floors with health with medical help me out, Jeff, with
Medical expenses.
medical
Yep.
expenses, and then we're used to in the old days the 2% floor on miscellaneous deductions, which of course are all gone. But now we have this 0.5% floor AGI floor on charity, taking a charity deduction, and then back from it was there in 2020 and 2021 was this idea of even if you take the standard deduction, you can take some deduction on charity. In 2020, it was a weird above the line thing that was a bear to try to calculate. 2021, it was below the line. We interpret this one to be below the line as well. Why don't I bring them up? You can talk about any of these that you want or you think are worth kind of digging in on.
Yeah, so a few of them, as we just kind of run down that list, that whole 60% to charity thing, like I just wonder when are we going to start to call them 60%
Yes.
organizations? Like you
Yeah.
give them to so-called 50% organizations, but now it's permanent. So I'm curious to see that,
Right.
but that's just the very nerdy part of me. But from a true planning perspective, right, which is the more important thing to take away from today's call, what it really means and drives at is should you be making your charitable contributions this year or next year if you have a choice between them, right? Like clients may say, I give $5,000 a year or $500 a month to my, my religious institution, my favorite organization, whatever. If they do that and that's because they want to, that's fine. But if clients are looking to get the biggest bang for their charitable buck, then for itemizers, it may very well pay to shift those contributions into this year, maybe to make a
Yep.
larger contribution this year in lieu of making one this year and next year, because we don't have that 0.5%
Right.
AGI floor this year to get over. By contrast, and by the way, for those in the highest bracket, that's
We'll
even
get
going
there,
to be
Jeff. I know where you're
more
going.
the case.
That's the
I
next
know.
slide. Yep.
I'm foreshadowing. I'm
Go
foreshadowing.
ahead. Go ahead.
That's
Yeah.
even going to be the case to an even greater degree if you're in the top bracket. But even those lower, in lower brackets, they still are going to have to contend with that 0.5% floor next year. If you are not an itemizer, though, and let's say your client likes to give, $500, $600, $700 a year in cash to a charity, or maybe even like $1,000, it may make sense to push those contributions until next year, because if they don't itemize, they get no tax break for it this year. And next year, they would get a potential above, well, not an above the line. I don't really want to call it a below the line deduction either. I'll take that in a second, Roger.
Okay.
But potentially like this other deduction for charitable contributions available to non-itemizers, they will be able to get next year. Let me flip it back over to you to let everybody
Yep.
know what they're looking at here, and then I'll touch on that. What do I mean by not above, not below comment in a moment.
Yeah. By the way, I was asked to zoom in, so I did that. So appreciate those of you who wrote in and say it may be a little too small. So
This
I'm
is
going to
where in
first,
the in the crime movies, Roger, they go enhance, enhance.
yes, I enhanced for sure. Let's do a chair. Actually, I started with, I'm going to give away the ending a little bit there. So actually, so Jeff, actually, you mentioned cash donated to 50% organizations. We really need to start calling them 60% limit organizations because it truly is a 60%. Let's start with someone who only gives who gives $5,000 to charity, right? So that's not enough to get them into itemized deduction levels. And you'll see they're still taking the standard deduction. So that's this line here. I'm taking the standard deduction still. But then we have this new section in Holistiplan where we're handling all these quote unquote below the line deductions.
There we
Um,
go.
okay,
Now
yeah.
we're talking.
Yeah. And now we already had that section for QBI. We've just added all these extra lines for this new stuff. And so you'll see this is a married couple. They got $1,000 each of deduction that they got to add on to their standard deduction. So that's the case where I'm not giving enough to get me into itemized deduction land. Let me do that though now, okay? So let's give, what was my AGI? 100,000. Jeff, let's limit us. Let's give 70,000 to charity, okay?
All right.
So the first thing we see is, and again, this isn't something I encountered much as in my time as an advisor, so people on the call may not have encountered this a lot of times, but you are limited. We remember it from the CFP exam. That's probably the only time we had to deal with it a lot, but we're limited by 60% of AGI for these cash donations. And so this person with $100,000 of AGI, they're limited to $60,000 of donation, of deduction. Now here's the new bit, right, Jeff? The 5%, the 0.5% floor. And so what now we could go into the details. There's a little bit of question we had on the interpretation of when you apply this 5%. Is it before or after the AGI cap?
Yep.
I think in the end it's going to come out in the wash, but like this is how we interpreted it. But just know that there may be some changes to how we handle this calculation based on what the IRS tells us. But anyway, this person, even though they gave $70,000, they get a deduction of $59,500. Now I'm going to bring up range calc in a second, which we haven't talked about yet. But what happens though is my AGI increases. Say I'm doing a Roth conversion or something like that. As I'm bringing more income into the year, this line here is going to increase. The amount of floor that I have to get over to take my charity deduction is going to therefore increase. And so as I add income, I will in effect be paying more than just my tax bracket worth of tax. So let me show that on range calc. It's actually going to be not a very spectacular range calc to start off with. For people who aren't familiar with this screen, we basically take the scenario just had and then we add $1,000 of income over and over again. Then we rerun the whole tax calculation. So Jeff, we know what's happening here, which is as I'm adding income, my $10,000 of disallowed charity is phasing
Yep.
in. So
That's
people need
right.
to remember that. Like I may be adding $1,000 of income through a Roth conversion or whatever, but in fact, my effective rate on that $1,000 is only 4.9% here.
That's right.
Now, once I've exhausted that and all my charity is now deductible, now I'm actually phasing out again. So, and it's so small, it's almost impossible to see, but it's contributing 0.1% of extra tax. It's not really impactful at all. But as my as my income rises, my charity deduction will start to melt away, and it takes a long time for that to happen. So that's what range calc is showing us. We have more spectacular range calcs to see later, but that's the story there. So let me see if
All
I can
right,
get.
while you flip back, Roger, I'm going to take a moment to dive a little bit deeper into these deductions. I have seen a tremendous amount of financial media reporting the charity deduction, the deduction for seniors, and some of the other deductions, the auto loan, the no tax on tips deduction, the no tax on overtime deduction. I've seen a lot of financial media talk about these as above the line deductions. I do not see these as above the line deductions at all. I can pretty much say without even flinching that the charity deduction and the deduction for seniors are definitely part of this so-called below the line deduction category. That's my silly terminology for it. But because the charity deduction is exactly what it was back in 2021, we're just changing the numbers. So we already know how it was interpreted then. We don't have to reinvent the book.
Yep.
And the senior deduction is sort of meant to replace exemptions, which were in that same sort of group as well. Now, there is some question about the no tax on tips, the no tax on auto and interest, and no tax on overtime, which we'll talk about in a bit. But I very much view those as being in that same group of deductions. And I don't love calling them below the line deductions either. They certainly are below the line, right? The line being AGI. But traditionally, when we have said below the line deductions, what we mean are either your standard deduction or itemized deductions. And the charity deduction, the senior deduction, and I believe the other three as well, the auto loan interest, the no tax on tips, the no tax on overtime, belong in that category of it's even below your itemized or standard deduction, where the QBI deduction is, as Roger mentioned, meaning that it's now another group. And if you were participating on our last call, you probably heard me say something like, I would not be surprised if we had a new schedule next year, schedule 99,402 for in order to be able to keep track of these, to keep the 1040 shorter. That's kind of been the trend in recent years. And there's already been some overtures from the IRS saying we would like to keep the 1040 as intact as possible. So think of these as a new group of deductions. And the key planning point for you all, not for you all, but for your clients who you're doing this with, of course, is that even though you don't have to itemize in order to claim these deductions, so they can be taken like above the line deductions, whether you itemize or not. However, unlike above the line deductions, they will not reduce AGI. So when we're looking at, how much of your client's Social Security is taxable and how much are their Medicare Part D and Part B premiums and everything else on a tax return that's keyed to AGI, which is basically like everything except for the tax brackets and the QBI deduction, all of these will not impact that line, the AGI line. So very, very helpful in some respects, but in other respects, really are not going to impact things. For instance, if you, just as a kind of example here, if you found yourself in a situation where you gave away a significant amount of money to charity via a charitable contribution, that happens below the line. You can give $1 billion away. It doesn't change your Medicare Part B or Part D premiums. In the same way, this charitable deduction for non-itemizers, the no tax on tips, the no tax on overtime, et cetera, down the list, they will not have an impact on AGI. That is the clear and principal planning point to take away from these deductions.
Jeff, have you trademarked below the line deduction? Just a
Why'd
thought.
you ask me that on this call? Roger, someone's going to do it now. Someone's going to scoop me.
They'll just say yes, and then they won't.
Yes,
Okay.
I did. Yes.
I came up with a few takeaways for advisors. One is, you mentioned this earlier, like for people who, if you're not used to itemizing, but you still give the charity every year, they always take the standard. There's a reason to save those receipts now, because suddenly after all this time, you actually will be able to take a deduction on it. You give X amount to your church every week or something like that.
Yep.
Save the receipts, like keep the documentation. I think if you give property like to Goodwill up to $250 of value, you don't need to have a receipt for it. So anyway, that's a thing you can tell your clients to do, is like, hey, everybody should be able to get some charitable deduction now, whether you itemize or not, but they just need to change their behavior to remember that it's a thing worth recording. I wrote that down. And then these last two, I mean, honestly, the 0.5%, we saw it wasn't a huge hurdle to get over, but it does make a slight stronger case for donor advised fund. It gets, getting over that hurdle. If you gave to charity every single year, you lose a little bit of deduction each time. It's a small amount. So grouping, so that you only have to get over that hurdle once with the donor advised funds. And of course, QCDs have no issue of a 0.5% hurdle rate to get over. So again, those are slight. I would say the big one is just remind your clients like, hey, here's a deduction you didn't know you had before, and now you have it. All right. You almost gave this one away, but we're here now. We'll get back to SALT, but there is a new limitation on how you take itemized deductions. We used to have the P's limitation back in pre-2017. This one's similar idea, but different way that it's been implemented. Basically, the policy thinking is, hey, it's not fair that people who make more money or in higher brackets get more value from their deductions than other people, which is actually true because at the margin you get more off when you have a deduction. This
Right, your
caps it at
deduction is taken at your
35%.
marginal rate.
Correct. So this caps that at 35%. I'll pull up an example if you want to kind of talk through it, Jeff, because the range calc is kind of interesting on this.
Yeah, so effectively what we're really saying is that if you're in the 35% bracket or below, this provision does not impact you at all. What happens though is that as you move into that top bracket, that 37%, you're basically causing yourself, and I'm sure we'll see this on range calc here, about a 2% increase in taxes because effectively you're paying tax at a 37% rate in your bracket, and then you're deducting 35 cents at the deduction level. So you're going to have a net increase in your taxes, even if you're doing something that would be otherwise deductible in that top bracket. Now, one little note here, Roger, as I see you pulled up the slide. What I find to be fascinating, I like to think about what will happen in the future. The way they wrote this law, they didn't actually write, a fraction of the amount, like 2 slash whatever the top bracket is, right? The way it's actually written in the law is you subtract 2/37ths of the value. So I wonder, like, what happens in the future if the top rate is changed to 40%? Do we still end up in a scenario where we're subtracting 2/37ths of the value? And what does that look like? Because that 2/37ths is actually hard coded now into the tax code. Be very weird to see that scenario, but it's something that could happen in the future. So anyway, those are the types of things, Roger, that keep me up at night. How about you?
That doesn't, other things keep me up at night, not that necessarily, but uh, this example here I have, this person is safely in the 35% tax bracket. So they have how much AGI? Total income, $800,000. I gave them some itemized deduction. So what's going to happen? So right now there's no limitation on their itemized deduction because they're in the 35% bracket. I'm going to bring up range calc, and we're going to see as we add income, as ordinary income starts to slip into the 37% bracket. At the same time, that means that an amount of deduction is starting to phase out, so to speak. And so, like Jeff said, we're going to see that 2% little band on top. So here we go. And by the way, the reason we're doing all this is our job as financial advisors, oftentimes in tax planning, is we're moving income into a year or out of a year. And the reason I keep bringing up range calc and we keep talking about phase outs is really the big story in all of this stuff for advisors, is because it complicates our lives when we're trying to bring income into a year or out of a year, because it's not just so simple as filling a bracket. It's filling a bracket, but also monitoring how all these other things are impacting the marginal rate or the effective rate of that next amount of money. So that's what's happening here,
exactly
Jeff.
right. When it comes
Yeah.
to good tax planning, Roger, it's not about taking income when you're in the lowest bracket. It's about taking income when you're at the lowest rate. Like a classic example of that would be, the Social Security tax torpedo. Someone in a fairly modest income tax bracket, right? Like all of a sudden you're pulling down income. You were working and you were paying tax in the 24% bracket before you took Social Security. You didn't do any conversions because you said, I'll drop down to 22% when I'm retired. And then you start pulling out some of your income at 22 bracket, but you're really paying, let's say, a 40.7% rate because of that Social Security tax torpedo. Well, wouldn't you have been better off converting at 24% before you actually had? So, of course you would have. So it's about rate, not bracket. And, Roger, this is where I thank the lucky stars that we have something like Holistiplan, because as much as I spend my time in the weeds of the tax stuff, I can't eyeball this stuff, especially when you get to an example where there's a
We've
whole
got
bunch
one.
of things happening at the same. Oh,
Yeah.
okay, good. I'm glad
That's the
I'm
grand
glad to hear
finale.
that. I figured you might.
Yeah, I called it the kitchen sink. We've got them all in there. So
All
yeah,
right.
what's happening here, Jeff, is I'm in the 35% bracket. Once my ordinary income gets me up into the 37% bracket, I see that 2%, which is my itemized deduction kind of fading away. And you'll notice what was my itemized deduction? It was $60,000, I believe. Once I have gotten $60,000 into the 37% bracket. That means that all of my itemized deduction is now suddenly at 37% marginal rate. And now I've completed this process of limiting it. And so that's why then that 2% little piece drops off. That's what's happening here. So anyway, you're going to see this, the more itemized deduction you have, the more you're going to see this thing, the wider this will be, right? But it's always going to stack 2% on top.
Well, it's an interesting point even there, Roger, because you could think about, like, could you do a Roth conversion, and might it make sense to accelerate it at a 37% rate, because maybe you get more value of your itemized deductions in other years because you keep your income lower, right? Like, we think, well, my tax rate will never be higher than 37%. Well, actually, here your rate is higher than 37%.
True.
So, I mean, it's just wild.
Yeah, and actually, I mean, this isn't exactly what he said, but it's another argument for, yeah, thinking about what the future is. 2025 is the last year that someone in the 37% bracket gets full dollar value of their deductions. So this is the takeaway for me. Like, if you have a client who's like always going to be in the 37% bracket, they're just killing it. They're just killing the game. Well, like, bring some of those deductions into this year because they get full value for it. Right.
Yep.
So that's the takeaway I had, because
This would be
2026
that
on,
year to
that's the
make
deal.
that massive donor advised fund contribution to satisfy charitable intent for the next 5 years or so. Yeah.
Yep. All right. SALT. This is probably the one that people have read about the most, but they probably want us to talk about the most too, to make sure everybody understands it. So up from $10,000 max to a $40,000 max. Married filing separately is 20,000. And by the way, that's what it was before. It was 5,000 and 10,000. Now it's 20,000 and 40,000. The inflation adjustment on this is weird. They have a formula for how to do inflation adjustment, and you basically can inflate it at 1% per year. It's not
right. There is no, we don't
1%.
care about what inflation actually is. If
Yeah.
it's 0 or a million, it's going to be 1% inflated every year.
1%. Yeah. And it's also the same inflation, that 1% piece on these phase outs. And the phase outs, people are going to need to watch these. Again, another one of these new tax torpedoes. Married filing separate, it starts to phase out at 250 to 300, and then all others 500 to 600, which is, in my opinion, pretty narrow band, right? Especially when you look, and we're going to see it on range calc how impactful it is. Given the amount of dollars and the narrowness of the band, the impact is actually going to be pretty great when you're in that band on the phase out. I'll bring it up. And by the way, this is 25
just like
to 20,
it's kind of like the
29,
QBI deduction phase out. It can be very, very
yeah.
significant here. Yeah.
Yeah. Let me show this one, because I think people are going to want to know how to model this. They're going to want to know how to show their clients what's going on here, because I think it is going to impact everybody. And this starts 2025. So if you were smart and you told your client to delay that property tax payment until January of 2025, good choice, because this starts in 2025. All right. So where was I? Oh yeah, SALT deduction. So I have what are my two examples here? Oh, yeah. Okay. Let's show the first one here. I just had $400,000 of income, AGI, and then if I pop open Schedule A, I put in $50,000 of state and local tax, which of course is capped at $40,000. Now I'm gonna surprise you, Jeff. Actually, I'm not, because we talked about this before, but I'm gonna pop up range calc. Oh, by the way, we didn't talk about the fact that the phase out does not go to 0. The phase out drops you back down to the original $10,000 and $5,000. So like, you don't phase out to 0 with the income.
Like, your worst case scenario is continuing with the rules that we've had for the last
Right.
5 or 6 years. Yeah.
And in fact, what happens here, so that was the only deduction I had. And remember, the phase out for a married couple is $100,000. But if you look at this, so here it is, by the way, here's my 24% brag, and I add enough income that I'm starting to phase out my SALT deduction. Pretty impactful change, right? Like, it basically tacks on a whole 10% onto your effective rate in this range. But the question is, like, why didn't it actually phase out over a full $100,000? Well, the reason is this person, once they had phased out enough of the SALT deduction, they flipped back to standard deduction. So that's just a thing we need to watch for, is like, actually you will see on range calc, because I was wondering in the early days, I was wondering, like, why is this happening? Where's the full phase out? The reality is, if you have a client who before all this was taking standard, the reality is their phase out won't be over the full 100,000. They're going to phase out to the point where they're better off taking standard. And so it's actually a narrower band. So I'll show an example, actually, just so you can see.
And that's going to, by the way, Roger, that is going to drive those clients crazy
Yeah.
and those CPAs crazy. Like, look at all the work we did to try and get our itemized deductions and keep track of this and enter it into the system,
Yeah.
and it's for nothing.
And then they don't get, and still taking the standard. Yeah.
Yeah.
So, I mean, now that said, the reality is now that this is back in play, we're going to be looking at itemized deductions more closely. So here I did one where, if I can find where the heck, where is it? Refundable. Here we go. Itemized deductions. Yeah, sorry. So I added some mortgage interest and I added some charity to this person. So now they're going to be safely within the range where they actually phase out over the full 100,000. So I just wanted to show that. So the point here is that they had enough other itemized deductions that even as SALT phases out, they still were itemizing the whole way. And here you see this picture where over a full $100,000 of income, you're basically adding 10% effective tax onto whatever that cost of that next dollar of income is, because of the fact that we're phasing out this SALT deduction so quickly over only a band of $100,000 of income. So anyway, watch for that one. That's a tax torpedo for sure, right?
Yeah.
We're talking 45% here before state tax, right?
Mm-hmm.
Yep.
Which, from a planning perspective, there are a few things worth thinking about. Like, one is, if we're talking about always pay tax when your rate is the lowest, the opposite is also true, right? Like, don't pay tax when your rate is the highest. You'd never want to like do a Roth conversion within that range, because like, when are you ever going to be at a higher rate than 45% federal?
45%. Yeah.
Yeah,
Yeah.
I mean that's going to be tough to beat. Or the other way, like if you can get a client to take a deduction, what a better time! Like if you had the Goldilocks scenario where your client was at $600,000 of income of AGI, right, and you were able to get them back down to 500,000. Maybe it's a business owner, and you've always said over the years, like, you make so much money, you should put away more for retirement, and they always say, well, I want to take the trip to Aspen each year and blah blah blah. The client never was willing to like take the extra step and maybe put in a defined benefit plan. If you go to them now and you say, hey, Mr. or Mrs. Smith, Mr. or Mrs. Business Owner, you could still do this, but at the end of the day, after your 45% or $45,000 of additional federal income taxes and your, $5,000 hypothetically of state taxes, you can have $50,000 left, or we can put $100,000 into your defined benefit plan and let it grow for the coming years. And when you're in retirement, presumably at a much lower rate than 45%, you'll be able to take it out and enjoy and take a lot more trips to Aspen then. How would that work? In other words, clients who were resistant before, when you tell them that at the end of the day, if they want to keep the quote unquote income or money, they're only getting 50 cents on the dollar, all of a sudden they may be more receptive to other approaches that you've suggested in the past. And in some cases, it might just be, hey, Mary, Bob, don't work so hard next year. Right? Like, stop working all that extra time. Don't worry about selling the extra home as a realtor. Why don't you have a little bit more time home with the family? Because it's just not going to be worth your time. Like, that is good,
Jeff, you're
valuable
killing the
insight.
economy here, man. You're making us all sit home and not do our jobs. Come
That's it.
on.
I'm crashing the economy. That's my goal. One more thought, Roger, before we move on, because I know we've got a lot to cover still. And it's just that in the past, one of the big gripes about the SALT deduction was that there was no relief to the marriage penalty. Two single individuals each got a $10,000 cap. One married couple had the same total $10,000 cap.
Yep.
This law actually makes the marriage penalty worse,
Right.
because
Phase
not
out.
only do we have the same $40,000 max for single couples and those who file joint returns, but they phase out at the same income levels, and married couples have more income on average than single folks because there's two people
Yep.
that could potentially work. So you phase out the deduction quicker and you phase out the same deduction quicker. So the marriage penalty is actually a lot worse.
Yep. Jeff is killing the economy and marriages at the same time. Yeah. All right. So
That's it.
like, rolling on.
Well, think about all the divorce attorneys that are going to pick up work. I'm trying to
Yeah.
balance the
Yeah.
economic impacts here, Roger.
Yep. All right. Well, let's look at the enhanced senior deduction. That's what it was called, by the way, several weeks ago. I noted in the final bill, which is called like temporary senior deduction, didn't have a cool name. So I don't know what the world will kind of land on as a name for this thing, but this is the extra deduction that is in addition to the existing over 65 deduction, which got tacked onto the standard, which is not going away, by the way. This is a brand new deduction available to people over 65. despite how it's been presented to the world, it is not something that makes Social Security tax-free, right? It is really just a deduction you get if you're over a certain age. We interpreted it to be below the line. You're 100% certainty on that? We're at high certainty on that. I don't know, but that's a below the line deduction.
I would say I'm at 100% certainty. Yeah.
Okay. And we'll look at the phase out in a second, but the phase outs are kicking pretty early. I mean, like $150,000 for married filing joints, 75,000 for everybody else. That's a pretty early phase out. And again, it's only over $100,000, so it happens quick. So I can put it up on screen if you want to see where that shows up in the software and then how it's going to behave within something like range calc.
Yeah, effectively, everything is a cliff, right? We talk about the Medicare Part B premiums being a true cliff because $1 too much is too much. But even something like this, where there's a phase out over $100,000, it's just a wider cliff, right? Like you're going from a full deduction at some point to no part of the deduction there. And also worth noting, and Roger, you may have mentioned this, but just to emphasize, whether you have one person or two people who qualify for this deduction, the full phase out occurs over that $100,000. So a married couple where one person is 65 and one person is 62, they lose an additional $6,000 of deductions over that $12,000 income range. But a married couple where both of them are 65 or older, they will lose $12,000 over that income tax range.
Good point. Yeah, we had some people write in early days about if we were sure of the math on that. I feel pretty good about it because it quotes a percentage in the law instead of a dollar amount, whereas some of the other stuff does the dollar amount. These
and
people
it says of the amount like referenced above. So yeah, I think that one's pretty clear. Yeah,
we feel good on that. Okay, these people, I'm going to make them over 65 now. For people familiar with our software, like if you put in a birthday for your clients, and I recommend you do because it unlocks some functionality in the software that's worth having. If you put in a birthday, it will automatically notice if they're over 65 or not, but I'm going to override their birthdays and say, yes, they are indeed 65 or older. And then you're going to see, again, down in this below the line section, we're calling it other deductions in QBI. There is the enhanced senior deduction. And again, there is a phase out. So for those of you doing Roth conversions, a lot of Roth conversions happen between age 65 and 70. That period where potentially they're not working and it's before Social Security gets taken. But there it is. There's a new tax torpedo phasing out over that $100,000 of income. It tacks on an extra, 2 to 3% onto your effective tax rate for that next $1,000 of income. So again, like it makes all these Roth types of motions we're going through a little bit muddier than they were. But that's the new reality for us is a lot of looking at range calc. Jeff, remember my funky thing about the definition of age 65? That we found?
I do.
So, all right. So if you look at Form 1040, the existing over 65 deduction, if you look at the middle of the page, it says anyone born on January 1st, you can actually take the over 65 deduction, the old one, a year early. So when you're 64,
which still exists,
right? Yes.
Yep.
Yes. So, but this law, when it defines this thing that's over 65, it says anyone who is 65 at the end of the year. So we think, and I'm hoping they patch this. I don't know. This is crazy, but we coded it the way the law says, which is someone born on January 1st. It's a different rule as to whether or not they're age 65 or not because of this thing. I don't know. Well, who knows how it's going to come out.
Even the question of are you 65 does not have a clear answer under the tax code.
Yeah. So that's the fun of this stuff at 11:30 at night, the night before the bill's signed. So anyway, that's the story there. But I think the important part is also it's worth educating our clients. Like this is not a no tax on Social Security. This is a deduction available to people who are over 65. I get that it's been promoted as something that offsets Social Security. It's really not. It's independent of Social Security.
Yeah, you were very kind to say some people interpreted that. I think that was your wording on the last slide. Some people interpret. No, people were told that it was no tax on Social Security. I really don't want to get into politics, but even just articles out there said, that this is the reality is more people now don't pay tax on their Social Security because they have more deductions. right? So more people don't pay income tax. That's really what it comes down to. But it's not because the Social Security is tax-free. It's just because we've created more deductions. And the net result here is about 66, about 2/3 of people before this bill did not pay tax on their Social Security because they didn't have a lot of other income. So their Social Security was already tax-free. This now takes it to about 3/4 up to maybe 80% of folks now will not pay tax on their Social Security. But of course, we all, because of the work we do, tend to disproportionately represent that 20% or so of clients who will continue to pay at least some income tax on their at least some of their Social Security benefits.
Got it. All right, we're looking at the clock, we're gonna do a 2-for-1 here on tips and overtime, although they are slightly different. So this was called no tax on tips in the bill. Our understanding is, or our interpretation is, this is a below the line deduction. I think
Yep.
we're at 98% on that. We're not 100% on that, but we're 98% on that, below the line rather than above the line.
Yep.
I need to show people how to enter that within Holistiplan because we had to tweak a thing related to Schedule C. Because the reality is, on all these sorts of things, they're trying to prevent abuse. And so it's, there's always a lot of rules around self-employed people and abuse. But the reality is there are definitely professions, and there's some of them named in the actual bill, like, a hairstylist, for example, where
Yep.
traditionally tips are a big part of their income. So you can't do something broad brush and be like, oh, you can't be self-employed and get this, because the reality is a lot of self-employed people will in fact get this deduction. There's like pages and pages of wording about what is qualified or not, and the IRS has been instructed within 60 or 90 days to come up with another list of
Yeah.
approved
Yeah.
professions and stuff
Basically, like
like that.
publish a list of businesses that typically accept
Yeah.
tips. Yeah.
So I'll just say, like, just for people who are watching who are Holistiplan people, there's a couple places where you can enter tips. Okay, one of them is within wages here. You see I've given this person tip income. That's a dedicated line there. The other place we had to add a line for this is in Schedule C. So here, this person, I put hairstylist, and there's a place to enter Schedule C tips in here. And so I'll show you in a second, but it drops down again to that below the line area. And then there's a phase out also. There's also some math that I think we got right, but we're going to have to dig into it as time goes on about how this impacts QBI, because you don't want it, the IRS, we're assuming, does not want a double counting situation where if I have
Mhm.
self-employment tips, which is also part of my QBI, they don't want me to get a deduction on both things. So
Yep.
we did some math to back that out. We're going to have to see in the end, like, how exactly the math all works, but I think we got it pretty close. Um, Again, range calc. There's a phase out. I don't think I said what the phase outs were while that's running, but phase outs, this is a pretty wide phase out. So for a joint filer, it's $300,000 to $550,000. So I would classify that as a wide phase out. And so you're not going to see this really tall, colorful thing on top of your ordinary income. It phased out over $250,000, just to show that. So here we go. So I'm in the 24% bracket. Now my tips deduction is starting to phase out. And so therefore that's this full $250,000 phase out piece. And then my tax on tips, my deduction for tips income finally completely melts away here. That's what's going on there. And as far as takeaways go, I mean, I wish I had something less vague than this first bullet point on the right, but it's like, if you have clients who are in one of those traditional tip earning professions, they and you are just going to have to watch where the regs come out on this, because it's still a little bit up in the air, I would say.
Mhm.
And yeah, there's another tax torpedo for us to contend with for clients who have tip income.
Well, I got two quick thoughts here to add, Roger. One is just, if there's anything I know more than taxes, it's hairstyling. I just, that
Sure.
is, yeah, I mean, clearly you could see, I mean, this
We've
is,
noticed. Yeah.
yeah. The other
Yeah.
thing, though, the real point I wanted to make, though, is that both of these provisions, the no tax on tips, the no tax on overtime, we said we're going to do a twofer here. Well, both of them are really like no income tax on tips or overtime. It's important to remember that employment taxes are still going to
Yes.
apply to these things. So like FICA, self-employment, you don't get it because it's not an above
Below
the
the
line
line.
deduction. You're taking it below the line, if you will. You're going to still have FICA and self-employment taxes on these things.
Yep. So overtime, I won't show an example for overtime. It's very similar to tax on tips. It shows up in the same place in our system. So you can enter your overtime in the wages section. It'll show up in that below the line area. The phase outs are the same. The bill is very vague as to what is going to be allowed or not. I know there's already statutory stuff about what is overtime or not, but like there's basically one line, one sentence. It says like the IRS has authority to like figure out and make sure people don't abuse it. That was it. That was like, all right.
Yep.
So there's going to be more to
Basically, like
come.
as defined under the fair labor laws, blah 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 blah
Right,
blah.
right,
Yeah.
right.
Yep. The one thing that is worth noting here, though, is and this has already upset a couple of people I know who are like, "Oh, all of my overtime is tax free." It's not. It's only the extra pay that you receive for that overtime. So, for instance, if you normally make, let's say, $50 an hour, and you get time and a half for overtime, you're getting $75 an hour. It's only that $25 delta that is
Right.
actually eligible for this no tax on overtime. The regular $50 you make, even if you're choosing to work more than 40 hours or whatever, that is still taxable. It's just the bump in pay you get by going into overtime.
Yeah, we're going to have to we need to go back and look at our data entry to make sure that we give people a hint to make sure they enter that right. By the way, another thing we need to go back and fix, married filing separate filers, my interpretation is if you are married separate but not living together, you can indeed take this deduction. If you are living together, you cannot. So Jeff, we didn't talk about that beforehand, but that was me late night the other night reading that stuff. But there's a definition of what it means to be married in section 71001 or something like that. And
Sure.
so
Yeah, that one. Yep.
my favorite, it starts with a 7. Anyway, I think we need to fix that because right now we are saying anyone married filing separate does not get it. I think we need to flip that. We already have a checkbox for living together, not for married separate. Anyway,
It's sort of the rule that you can file separate, like a single return
yeah,
if you're married, if you're living in separate places for the full year
yep.
and so forth. Yep.
Auto loan interest deduction, we interpret again this to be a below the line deduction. I'm just going to show where you enter it. We don't need to see another range calc phase out, but pretty narrow phase out on this one, right? Super
Yep.
narrow. And it's only on the interest on the loan. And I know Jeff, you had some thoughts on like how big a loan gets $10,000 of interest. So maybe you
Yeah, I
can
mean, it's
riff on
tough to
that.
get $10,000 of interest a year on a car. I
Yeah.
mean, let's say you have a 5% loan rate, right? Which is not out of the norm right now for cars. You need a $200,000 loan to get, $10,000 of interest. So it's not there. What I did do though, Roger, I was having a little fun before we got on here too, and I asked ChatGPT. I said, ChatGPT, what cars are assembled in the US that also qualify for the electric vehicle credit that's going to stick around for another like month or so here, so that maybe you could get both the electric vehicle credit
Wow.
and this deduction at the same time. And it did give me back a nice list of vehicles here. I won't read them all off because I don't want to preference one over the other, and I don't want to read off about 30 vehicles that it gave me, and I don't even know if it's right. But ChatGPT
It's
did
always
give
right.
me a list of
It's
vehicles, and
always
it
right, Jeff.
sourced them.
Yeah. This is where you enter it. So like again, this is the below the line section. You can enter the amount of interest paid, and then we'll cap it to 10,000, and then the system will also handle that phase out, that AGI phase out. So I won't go into gory detail on that. I would just say the takeaway for an advisor is like if you're, and by the way, this is supposed to end in 2028. So again, like I don't think I'd rush out and buy a car just to get this deduction. It's really only if you're already in the market, maybe check with at the dealer, like if this car you're looking at qualifies or not, and maybe that would get you over the edge. But I just feel like there's not real decision, there's not really behavior change that a lot of advisors are going to see out of this one. All right, AMT, Jeff,
Back
AMT.
to the future.
We're going to try to explain AMT to people. I made a whole video, by the way, on our YouTube channel where I went into detail on what the AMT changes were. So if you need more time with that, you want to see me floundering around to talk about AMT, it's there. But two things, and one of them, actually, they are both on here. So first of all, the brackets stay the same, or the brackets didn't go somewhere else. The brackets stay as they were, 26 and 28, and then they inflate the way they've been going. What is changing though is the exemption, and the exemption, I think of it as like the standard deduction for AMT. I don't know, maybe you have another way to describe it, but like that's the thing you can knock off of your alternative minimum income. And that has changed. Like the threshold is dropped. And then also the rate at which the exemption phases out is faster. And the net impact of this is that more people are going to get hit with AMT. The second thing, Jeff, and I don't know if we've talked about this much, but like line 2 of Form 6251 is where you're adding back your SALT deduction
Yep.
if you itemized.
Mm-hmm.
And that used to just be $10,000 that you were adding back, but now for some people we're adding back more, and so that's actually that actually floats all the way down to your total income for alternative minimum tax. So that may actually also impact some AMT too. I didn't work up an example for that. I did work up an example for the exemption phasing out faster. If you want to try to take another stab at explaining what the heck I just said, I'll bring up I'll bring up an example for us.
Yeah, I mean, look, I think the big takeaway here is AMT still is not going to impact the overwhelming majority of your clients, right? Compared to what we were dealing with in 2017 and earlier years, AMT is still a non-issue for the overwhelming majority of people. I kind of look at this like the reverse of the estate tax exemption, where it went from a very, 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 very few people taking it to a very, 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 very few people having that issue. Here, we're going from a really, really, really small group of taxpayers paying AMT to just a really, really small group of taxpayers.
Mm-hmm.
It's still a very small percentage. It's just a bigger, small percentage.
Yep.
So unless you have ISOs that you're exercising for clients, probably even with the larger AMT, the larger SALT deduction, still probably not going to be an issue for most people, because as they get into those higher incomes where the exemption gets phased out, they'll have already phased out their SALT deduction back down to 10.
Yes.
But
Yes.
you may have these things come up from time to time. It's going to be more likely than last year, but just still not as likely.
I'll show you, Jeff, an example I worked up here. If anyone wants to like create a scenario that definitely is going to throw off some AMT, just put something in with a ton of long-term capital gains. That's what I did here. So I threw
Yeah.
in 1.3 million of capital gains, and I think nothing else. I think no other income. And so what I've got here on the left-hand side is the current law, the new law, versus what we thought it might be had they extended TCJA. And
Mm-hmm.
you'll see in this example, so 1.3 million in cap gains. Ignore the standard deduction piece because it's slightly different, but there was a difference of $6,000 of AMT. So my new law person got AMT. My old law person did not. If you really want to dig into it and get a Form 6251 in front of you, go down to line 5. That's the line where that exemption is happening. And in this case, because of that faster exemption phase out, this person has no exemption. So line 6, they're like taxable AMT income is the full amount. Whereas here, line 5, wait, where was I? I was looking at the wrong thing. Here it is. The wrong thing. Line 5, here I have a exemption of $138,000, like a major difference because it's
Mm-hmm.
phasing out faster. So AMT, more people are going to get hit with it. I mean, but like Jeff said, probably still not a ton of people. All right, we got to bring this thing home, brother.
Let's do it.
Credits expiring, some green credits. Some of them were part of the Green New Deal, but like Jeff said, some of them ending September 30th. You know, if you're buying an electric car, do it now. One of the things
Yep.
that we have a little more time to act on is if you're doing like energy efficient home improvement credit, which is, putting in new windows or new insulation in your house. Like if that was already on your client's list of things to do, like let's get it done this year
Yep.
and get a receipt for it, because like this is the last year they're going to be able to take credit for it.
And just to be clear, it's got to be done before the end of the year. You got to complete that work. So
Do it.
make sure you get
Work
it. Make
fast.
sure your
Work
contractor is
fast.
aware of that.
Yeah. And then on it, there's other ones that phase out, that expire. I didn't put them on here because a lot of them are like industrial, like hydrogen
Yep.
sequestering or ethanol, something or others. And it's
If
like,
it's a
that's not,
green credit, it's probably going away sooner than it was otherwise going away
yep,
before this bill. There's a
yep,
million of them. Check them out. But these are the ones that clients care about. Yeah.
yep. There's this new, I want to highlight this one. This one's interesting. So this is, if you give to charity and that charity happens to be a qualified elementary and secondary education granting, scholarship granting entity
Well
for
said.
elementary. I really was poorly said. Thank you, though. you get to take a credit. So as we know, a credit is worth way more than a deduction. So we've always been able to take a deduction for giving to charity. But for this very specific type of charity, you get a dollar for dollar credit, which is worth way more than a deduction. My read of it was that it only starts in 2027. There's a lot of infrastructure they have to build, like states have to get different organizations approved. There's going to be a list per state. Another thing that's kind of interesting is if you already get a credit at the state tax level, you don't get a credit at the federal level. So Alabama, for example, has an almost word for word credit. That I'm guessing they kind of borrowed from Alabama. Um, so I would imagine if you live in Alabama and are already getting that credit for these organizations, you don't get it at the federal level. But that was interesting. I don't remember seeing that before. So I would just say the takeaway for advisors is, and again, this is a couple years out, I think, but if you have a client given to this, like make sure they flag it to get the credit and don't accidentally put it on Schedule A. You get way more value out of the credit than you do for Schedule A. This is a non-refundable credit, but you can also carry it forward 5 years too. So that's a new one. That's a new one. Grab bag. And then I don't know, we can hang out for questions if we want, but we're kind of hitting up against time. QBI, not big changes, but there is a wider phase out. And then also, if your income gets below a certain amount, they just say, look, we'll give you something, $400. Um, the rest of these are very businessy specific. And like, if you are in this world, like I'm in the startup world. So like I'm hyper aware of QSBS and I'm hyper aware of the R&D expenses changes. I'm less hyper aware of how bonus depreciation works. So Jeff, any comments on kind of business, these sort of things? You had another one also that I didn't have on the slide that you wanted me to cover.
Oh, yeah, just that the limitation on excess business losses is made permanent. But yeah, I think we've hit the really big ones, and I'm happy to stick around, Roger, and continue to answer a few questions that have come in. But
Jeff,
if you want to give a big takeaway here, maybe before we wrap up,
Jeff,
I
the
know
grand
you've been
finale.
pitching this kitchen sink example to us.
Let's do it for the people who are still around. Let's give them the kitchen sink because we talked about how there's all these new phase outs and it's going to muddy the waters on a Roth conversion or any sort of things where we're trying to fill brackets, right? Let's look at this example on the right hand side. This person has $196,000 of income. They are in the 10% after they got a lot of deductions, but after all this stuff, they're in the 10% marginal bracket. So you're thinking, all right,
Yeah,
Roth
low
conversion
rate,
time,
right, Roger?
baby.
Sure, of
Yeah,
course.
Roth conversion time. But look what we got. We've got state and local tax that's going to phase out. I've got I put tips and overtime in here, which I don't know how many clients have all these things happening at once. But and I had capital
It's all
gains,
right.
which
We
are going
call
to
it the
phase
kitchen
in.
sink for a reason, Roger.
Kitchen sink, baby. Let's look at this thing. This
All
surprised me.
right.
So I'm in the 10% marginal bracket, right? Let's do a Roth conversion for sure. Okay. So it's cranking away here. Remember, it's running the calculation over and over again. I'm in the 10% ordinary bracket, but I've got capital
I love
gain.
this.
My capital gains are moving from 0 to 15%. I put medical expenses in there too. So that has a income floor also. So as income rises, my medical expense deduction gets smaller. I had charity getting smaller, 5% coming in from overtime and tips. I mean, I'm in the 32% effective bracket there, right? And then I move up here in the 12% bracket, I'm in the 38.4% bracket effectively. So if you're just blindly looking at ordinary income brackets when doing Roth conversions this year and really for the rest of our foreseeable future, you're potentially missing out on some major hits to your client's tax bill. We see some other jumps right here. Here's that SALT deduction, right? Here's when I'm moving from 15 to 20% capital gain. So that's 55% effective rate on that next $1,000 of income there, right?
Yeah, really, Roger, anything that's not light blue on this, and maybe you can throw in the red, is effectively what is commonly referred to as a stealth tax, right? It's
Yep.
something that is not an actual increase in your stated tax, but because of its knock-on effect somewhere else, it ends up causing it. They're under the table. Clients don't realize it, but they have a huge impact on their long-term success or failure of maximizing income when you're at the lowest possible rate. This is why we said before, don't focus on the bracket, focus on the rate. And you need great planning software like Holistiplan in order to be able to do that.
And Jeff, we can get to the questions if people want to stick around. I'm around too, but like I think that's actually a new thing. Like maybe our clients, like you said, it's like a stealth tax, and even a lot of advisors didn't really think about this stuff a few years ago. I think it's more front and center as we think about it, and as more phase outs come into our lives. But maybe clients can't be in the dark about this stuff anymore. Like maybe as a
Mhm.
population, people need to start understanding that there's more to your incremental tax bill than just your brackets. There's all these phase outs to impact. Like we can't hide. Maybe we can't let our clients hide from this. Like we have to actually start explaining this in ways that we probably didn't before. It's just a thought. We'll see what happens. So it's a
I love the
cultural shift
idea. I hope
potentially.
it happens.
Well,
Yeah,
it maybe, I mean, it's a lot for a client to understand. Taxes are
it
already
is.
hard enough, and now we're making it harder for them, right? So
Yep.
it'll just be interesting to see how much this enters like common discussions about taxes versus kind of behind the curtain advisor stuff. Can you see the QA list, Jeff? Do you want to start popping some off?
Well, first off, massive kudos to the team who have already answered, the Holistiplan team. I see they've already answered over 100 questions. So amazing job to the team there as they were going through. A couple of them here that we can just rock through. So for the QSBS, does it still is this still the same business that has to be a C corp from the start, or could be an S corp converted to a C corp to get the same benefit? Look, there are lots of cool ways you could do corporate reorgs and so forth, like F reorgs and things like that. The key here is in order to qualify for the increased benefits under the OBBA, which Roger, I don't even think we mentioned. Some people are now starting to call ABBA. So if you hear the term ABBA, you now know what it means. It's not just
Um,
that 70s band. It's also the tax law that was just passed. But the stock had to be issued afterwards, so it's only for
yes,
newly issued corporations. I suspect there's going to be a run on trying to take old QBS stock and turn it into new QBS stock. Of course, that would extend the timeline for the five
interesting.
years,
Yeah.
presumably, but it may also allow individuals to to get a higher benefit there.
Well, and also
We
it's
talked
75
about
million now instead of 50 million. So if you convert
that's a
S
big
to
deal, right? A
C,
lot more companies qualify. Yep.
yeah, so
Yeah.
you can get in, and then it's 10x that. So you're talking of $750 million potentially of tax free if you nail it right.
Yeah. Almost $1 billion of tax-free
Wow,
gains you're
I
eligible
want that
for, right?
client. All right.
Yeah. Yeah. Forget the client. I want that stock.
True.
Yeah.
What else we
Can
got?
you please briefly touch on minor Trump accounts? Yeah. Look, at the end of the day, they're built on the IRA chassis. You can fund them up until 18 at a maximum of $5,000 per year, adjusted for inflation. There's not going to be any sort of special tax breaks when it comes out of the account. It's just going to be like an IRA distribution. And because the contributions are going to be non-deductible, because they didn't want to add more cost to the bill, that means dealing with the pro rata rule for Trump accounts the same way we have to do with like accounts that IRAs have mixed money in terms of pre and post tax dollars. And it is going to have to be invested in effectively a US index for the first 18 years of the kid's life. The one other thing to note here is that we're not going to have these for a year afterwards. That's the first time that these accounts are going to be opened or being eligible to be opened if we're ready at that point. And any child born between this year in 2025 to 2028, there is a pilot program here where they're going to we provide the right information for this child, they are going to get a newborn gift, a thank you for being born gift of $1,000 into their Trump account automatically at no cost to their parent or to that child.
Yeah, we didn't build a new like line into scenario analysis for the Trump accounts because, like you said, they're similar enough to other things that exist that at least initially we think people can just model those. And also there's rules about when you can even take it out. So it's not like you're taking money out this year anyway. So as that develops, we can adjust the design of scenario analysis in case there's something special we need to do to handle the Trump account distributions.
And a lot of questions here on reporting that we've got, like, where are they going to put this? Or here's one like, do those new Trump accounts require a Form 8606? The answer to all that is like,
Don't know. Yeah.
maybe. I think 8606 is the most logical place for those to be reported, but we'll see. Don't know. Yet to be determined there. One more here, Roger, that we'll touch on is just so if you're going to give $125,000 to a donor advised fund, you should generally do it in 2025 versus 2026, right? Assuming AGI of $500,000. I would say Always look at everything. You cannot judge what you should do based on one single provision. That's why you do need software like this that does look at everything. But on the
Yeah.
whole, if you had the option of to do that this year or next year, you may very well want to do it this year. The one caveat I have to say, though, is that if you find yourself, like if you're giving $125,000 this year versus, let's say, doing half this year and half next year, if you find yourself knocking yourself down brackets and using some of that deduction at lower brackets, it may actually net be better to have some of your deduction lost next year, but to have it offset income at a higher bracket. Again, it's why you always want to look at the projections. Run the numbers, right? Like that's always what I tell
Yeah.
people. Let's run the numbers. Don't guess. You have the software to do it, so do it. That's kind of my
Yeah.
advice.
I mean, if you think about, if the question has to do with that 0.5% piece, it's really not a very high hurdle rate. I mean, if you're in the million, if you have $1 million of AGI and you're in the 37% bracket, so that's going to carve off $5,000 of deduction, and $5,000 at 37%. Jeff can do that in his head, but I can't. That's $1,850. That's someone
Well
making $1
done.
million. That's someone making $1 million of AGI. That floor, that 0.5% floor impacts their taxes by $1,850, which is real money, but it's not tens of thousands of dollars. It's not huge dollars for someone making $1 million, right? So it's,
Right.
I don't know if I would make huge behavioral changes based on just the 0.5%. There's a
Right.
lot of other stuff you got
Effectively,
to run
Roger,
numbers
like
on.
as you add more income, you kind of, and I'm going to go into the math nerdiness here, but you asymptotically approach 2%, right? Like that's because that's the worst case scenario, right? Is you're losing 2%. So
Oh,
that
so
I
you're the
think,
2% on the 37, is that what you're talking about? So I was talking about the floor, the
yep.
0.5% floor, but you're
No,
right.
I see what you, okay, yep.
If you're, yeah, so that, yeah, this is why you got to run the numbers. There's no one rule, but yes, if your client is like safely in the 37% bracket for years and years to come, then there is a stronger argument for bringing those deductions into 2025. I could see that for sure. All right.
Good. Well, Roger, we could probably answer questions all day, but I
We
know people
could,
have to get back to
I
like
think
real
there's
client
several,
stuff.
like, we could definitely do follow-ups about like tax torpedoes. I'd love to do like a charity one because like there's way more. We could, the concept you were talking about over time, if you give too much to charity, that's not the right word to say it. If you
Yeah,
take too
well,
many deductions, you're taking deductions against smaller and smaller bits of income or income
yep,
tax, and it's not worth it. It's worth it to offset high income tax. Anyway,
yes.
there's a lot we could
Yeah.
do. Let's plan to come back sometime soon, Jeff. How about that?
Let's do it. And a shameless plug before we all go. Roger and I and Holistiplan are always posting things when we figure them out or learn them. So if you don't already, connect with us on Twitter or LinkedIn or whatever, do that so that you can help, that you can stay as informed as possible. We love putting out new things like this. If this was appealing to you and you want to be apprised as we learn things and make new developments, feel free to connect with either of us. We love to keep in touch with folks.
Sounds good. Jeff, I appreciate it. I'm really grateful for our collaboration over the years. It's been a blast. You make
Same,
this
my
stuff
friend.
fun. I appreciate it. Thanks, everybody.
Absolutely.
Thanks for joining us.